Welcome to the Company Value Investor channel. It's been a while since the last time I conducted an analysis on a publicly traded company. But the reason being is because I've updated and created new models for the program so that it makes it easier for the average investor to decide whether they want to invest on a certain company or not. Now, the first thing I want to focus on is the price. In this video, we're going to analyze AT&T. Currently, the price for AT&T as of today's date is $36.15. Average investor, I want you to think of the current price as your FICO score. Whatever you do, whether it's good or bad, the credit cards will either punish you or reward you. Same thing with the price of any publicly traded company. If they do good things, then the market will reward them with a higher price. If things aren't going as planned or not as good as they thought they would, then the market will punish them, and the price of their stock or shares will the price of the stock will drop. So remember, think of the current price as your individual FICO score. Okay, now number one is the rate needed. This is the percentage that the company must earn to meet the expectations of both creditors and owners. Average investor, think of this as your credit card interest, the interest that you pay on your credit cards. It's basically the same thing. Number two is the amount expected. This is the amount of capital that the company must earn in order to meet its obligations. Average investor, think of this as the amount of money that you need to make in order to make all of your monthly or yearly payments. Number three is the amount made. This is the company's real earnings. Average investor, think of this as the amount that you actually made at the end of the month or at the end of the year. Remember, any positive here is good. Positives here are really good. And the last section, number four, is the amount needed. This is the amount of capital that the company needs in order to maintain its current operations. For the average investor, think of this as the amount that you need on a monthly or yearly basis to maintain your current lifestyle. So in essence, when I'm analyzing a company, I want you, average investor, to think of it as put yourself in his shoes. The price is your FICO score. The interest rate is the interest that you pay on the credit card, and so on. So if you keep that in mind, I think it'll make it easier for you to understand the rationale behind the analysis and how you can better select companies or stocks that you may want to invest in. I hope that the analogy made sense. It might not be 100% accurate, but it's the closest thing that I can think of that'll make the correlation between a corporation and an individual. If I start talking about internal rate of returns or outflows, cash inflows, or ratios, the average investor or the average individual will not be interested, because unless they know, it'll be difficult for them to correlate the company and how it works. But for the average investor, when they put themselves in a situation where they can understand how everything is interconnected, then they'll be able to make a better or more informed decision based on what they see or what they read or what they understand. Okay, so let's start with the analysis. In 2016, the AT&T Corporation had an average stock. The stock was actually undervalued and it was not a profitable corporation. Okay, the first thing, average stock. The reason why it's an average stock is because in 2016 they had a price to book ratio of 1.8, which is decent. However, the retained earnings percentage was less than 9. That makes it an average stock. Okay, now why is it undervalued stock? Well, in 2016 it should have been a little higher than 36. Than what the current price is, $36.13. It should be close to about $42, $43 per share. And remember, this information is coming directly from the company's financial statements, their balance sheet, their cash flow statements, and their income statements. So in 2016, AT&T was not a profitable corporation. Why? Because if you look at the analysis here, the company analysis, you'll see that they were negative 21. Although they had real earnings, they did not meet the expectations or the obligations of their owners. Okay, with that being said, we'll analyze the company for the last 4 years. And in 2015, again, average stock, undervalued stock, not profitable. In 2014, it was a strong stock. The stock was overvalued and the company again was not profitable. And in 2013, the company had a strong stock. It was undervalued, but again, it was not profitable. And the reason why you keep seeing not profitable is because the amount expected has superseded the amount that it really made. Okay, now that we've analyzed the company for a few years, going back to 2016, the reason why I go back to 2016 is because they haven't updated their financial statements with the SEC. But in 2016, well, actually the last 4 years, the company has had 2 positive cash inflows and 2 negative inflows. In 2016, they had positive cash flows of 667 million. In 2015, they have negative 3 billion. And in 2014, positive 5 million. And in 2013, 1 billion. Those are just rounding off numbers. However, what makes this company not an attractive company is the fact that they've spent a lot of their money in the last 3-4 years investing. Although they've had the same amount for the last 4 years in operating, meaning operations, operating activities, they've spent entirely too much money investing. And that is the one thing that has really hurt the AT&T company. The fact that they've spent a lot of money investing and very little on financing, and they've always had normal operations between $31 billion and $39 billion. So in today's current price of $36, the company is doing okay, but that's not the question. The question is, would I invest in this company? And the answer is no. I would not invest in AT&T Corporation at this time because of the fact that at best it is an average stock. The stock is in some cases undervalued, but the company is not profitable. So technically what I'm doing is I'm putting the company to several different criterias. I'll give you another example. If I was to invest, let's just say $10,000, and the reason why I'm choosing $10,000 is because I use that as a rule of thumb, a guideline. If I was to invest $10,000 at 36.13 cents per share, I would have 277 shares in the AT&T company. At the end of the year, the company is not going to give me a real profit. If anything, by the end of 2018 today, I would be losing almost $2,000 on this investment. And this is not a good company to invest in right now. We have analyzed the AT&T company in several different ways, and again, would I invest in this company? No, not at this time. The one thing that I want you to remember is that even though this company might not be an attractive company today, maybe in the future, maybe in a few months, 6 months from now, I conduct the analysis and the price changes, maybe it'll be an attractive company. The one way that I know or realize that a company is profitable and the stock value is good meaning it's undervalued and it's good, is when all these three sections here are green. When they're all green, then I'm able to analyze and look into it a little further, and it will tell me all the benefits or the drawbacks that the company has. So the first sign is when I see yellow and red, that's usually a sign for me to skip that company. When I see all green, all of the items here that are green, then I go forward and conduct a very thorough analysis, just as I did in this video. I will continue to do videos the same way. Pick a company, break it down, give an analysis for a couple of years, and then break it down into different segments, so that at the end, at least you, the average investor, would have a better understanding or a better idea of what to invest in. That is it. Thank you for your time, and as always, keep investing.